Well, hello and a very warm welcome to this Scope webinar on central bank digital currencies, opportunities and threats for European banks. My name is Keith Mullin and it's my great pleasure to be hosting this session along with Sam Theodore, who is a senior consultant at Scope Group. Now, in a few moments, I'll hand the floor over to Sam, who will give some comments on the evolution of CBDCs. And it's worth noting that Sam's written a couple of papers recently on both central bank digital currencies and private cryptocurrencies. Now, at the end of this, if you don't have access to those or haven't seen them, they are on the Scope website, but please feel free to drop me a line, k.mullin@scopegroup.com, if you'd like a copy of both of those. Now, the central bank digital currencies paper that Sam wrote was originally published on the 18th of May. And as I've mentioned on previous sessions like this, as a service to the market and to market stakeholders, we think it's quite a useful service to take some of our published material and evolve it into a webinar format to give you the opportunity to ask questions. And so there is a questions function on the platform here. So as Sam is going along, please feel free to type your questions in. And once Sam has finished, we'll go to some Q&A. And at the end of the session, we are going to ask you to fill in a very, very short questionnaire, which should take no more than 45 seconds to fill in, which we'd appreciate if you can spare the time. So without further ado, Sam, great to see you. Welcome. And it's my pleasure to hand the floor over to you.
Thanks, Keith. Actually, one of the advantages of having a chat is versus writing a report is that when you write a report, you have to remain a little bit more formal, more in the mainstream. So once you get into a live conversation, there are no barriers. So that's really something that I personally find very enjoyable. Regarding central bank digital currency, let's call it CBDC, this is a very hot topic these days, right? So you have academics, you have central bankers, you have analysts, you have banks themselves, you have crypto enthusiasts, you have the media talking about CBDC and some of them saying how through CBDC, central banks will basically bypass and disrupt the banking systems. I think that's a far-fetched idea. I don't think that's going to happen anytime soon. I don't think it's happening. Why? First, because the central banks themselves are expressly, visibly, transparently saying this is not going to be the case. We want to work together. If we decide to adopt CBDC, we want to work together with the private banks, with the supervised entities. And number two, because CBDC will be useful for transaction accounts, but frankly, banks offer a huge range of products and services, loans, deposits, investments, others, and not to forget the fractional banking system, which creates credit in the economy. So I think to assume that banks will be threatened and with extension by the existence of CBDC is unrealistic. Now, what is threatening, I think, and not for all banks, but only for those banks which are not properly prepared for this new digital ecosystem we are going to be part of very soon, we are already partially part of it, is the whole package, not only CBDC. And this is actually going to be one of my concluding remarks for those who cannot stay till the end. The fact that it's not CBDC in and of its own, which is a threat, but the whole package. We're talking about open banking and open finance. We're talking about asset tokenization, 5G, the Internet of Things, blockchain, artificial intelligence, and CBDC being a component of this overall sea of change for financial institutions. Now, where are we before talking about the competition and the threat or opportunities for banks? Where are we with the CBDC? So basically, last January, the BIS published a survey that they undertook with the central banks. They worked with 65 central banks responded, saying that basically most of them are involved in some degree with looking at CBDC. Most of them in the initial stage, the proof of concept stage, and a few of them actually more advanced. Actually, as of now, the only banking system which has a generalized approach where CBDC is available is the Bahamas, the so-called sand dollar. Why? Well, perhaps because the Bahamas, you have 390,000 people spread over 30 islands. So having a digital currency is much easier than having physical cash, around 30 islands for small pockets of population. Now, the thing is that emerging market central banks, including and especially China, seem to be much more advanced, not seem to be, are much more advanced than banks in the developed economies, central banks in the developed economies. One key motivation based on this BIS survey for central banks looking at CBDC is financial inclusion. So especially in many of these emerging markets, it's easier. More people have access to mobile communications than they have access to a bank account. So by providing central bank digital currency, more financial inclusion would be achieved directly from the central bank to larger categories of unbanked population, which is a worthy goal. To some extent, this should also be the case in the US, which I think is the only advanced economy, large advanced economy, where up to 25% of households are either unbanked or underbanked. Now, this is very much not the case in Europe, especially in Western Europe, where close to 100% of the population has access to a bank account. It's much more difficult, say in France or in Germany, for a bank to refuse somebody from having a bank account based on economic reasons, not on reputation reasons, than it is in the US, where banks routinely don't accept bank accounts from everybody else. So that's why I think that the attraction for CBDC came first in emerging markets, including in China, where, again, a large category of population don't have access to a bank account, but on the other hand, are fully involved in payments through WeChat Pay and Alipay, digital payments. So it's a different system, and that's why Europe is somewhat behind. Now, when we talk about CBDC, there are two categories. The so-called general purpose or retail CBDC, which means digital currency going straight to the end users, businesses and households, and then wholesale CBDC, which relates mainly to transactions among financial institutions in payments, including cross-border payments, assuming there's a agreement among several central banks on sharing this digital currency. Right now, most central banks, including in China, seem to be focusing on retail CBDC. And that's the same approach in Europe by the ECB, the Bank of England, the Riksbank, not by the Swiss National Bank, and I'll talk about that in a minute. So again, in Europe, the urge for creating a new instrument to encourage financial inclusion is less obvious than it is in emerging markets, and I think than it should be in the US, although in the Fed seems to be the more reluctant party at this time to adopt a digital dollar, and I'll talk about that in a second. So where are central banks at this stage in promoting CBDC? Well, in Europe, seems to me that the most advanced is the Riksbank, the central bank in Sweden, which I think started this project a few years ago in 2017. they are at this stage where they are ready to start offering CBDC on a pilot basis to categories of customers, and for that they are working with the Handelsbanken, which is one of the largest banks in Sweden. And so again, a proof that it's not central banks on their own which are going back to the end users. They do that through intermediaries, through large banks. But even in Sweden, recently the governor of the central bank said that it's going to take them another few years to fully implement CBDC across the country. I think he mentioned 2026. So you can imagine this is not going to be tomorrow morning. In the UK, the Bank of England last March, published a discussion paper on CBDC. And last April, less than 2 months ago, a task force was created for CBDC between the Bank of England and the HMT, which is going to look into putting together a CBDC project for the UK. Again, much later than emerging market central banks, but as some people say, better late than never. In the Eurozone, the ECB last October published a report, a very comprehensive and I would say interesting report on the feasibility of a digital euro. And recently it announced that based on surveys and data which it gets from various participants, the ECB will decide in mid-year whether to continue, whether to initiate a project to create and launch a digital euro. My strong hunch is that they're going to go ahead with it. I don't think there's any other option. Having said that, I think a few years ago, the Swiss National Bank was focused on retail CBDC, and that proposal was turned down, I think, at the end of 2019 by the Federal Swiss Council, which found that the risks involved with offering a retail CBDC in Switzerland outweigh the potential benefits. And that's why the SNB is now focused mostly on wholesale CBDC, and actually they're entering into a partnership together with the BIS with the so-called multi-CBDC bridge, a project initiated recently by the Hong Kong Monetary Authority and the Bank of Thailand for from cross-border payments in digital currencies. And I think the People's Bank of China is also going to join that project. And now we're coming to the most reluctant large participant in that project, which is the US Fed. The US Fed has remained quite skeptical about digitalizing the dollar, not so much more recently, although the chairman of the Fed is on record saying that they'd rather get it right than get it first. There is now a project going on, which is led by the Boston Fed, together with the MIT, to put out a detailed research paper on the feasibility of a digital dollar, and if that project is to be adopted, how it could go about it. At the same time, other regional Feds, Atlanta and Cleveland, I think, are working on the aspect of financial inclusion. So I don't think the Fed will take an ultimate decision to avoid taking the digital route, especially since they're modernizing themselves, their payment systems with the Fed Now and other projects, which I think they're very positive and long overdue. As for China itself, I think they started to work on digital currency some 7 years ago without much publicity. Last year, they started to offer CBDC into several Chinese cities on a pilot basis, and I think people say they are ready to generalize the system very soon, perhaps even during the Winter Olympics early next year, to make a bigger impact. The problem, of course, is that of privacy. People's Bank of China is not independent from the government, So if people are going to use CBDC for their transactions, that means that these transactions are going to be visible in real time to government eyes. On the one hand, of course, it's a threat to privacy, but then again, that's not something new in China. It would be something very unusual in the democratic part of the world. But on the other hand, if it can help with money laundering problems, so be it. The problem is that, or the challenge is that if successful, this CBDC infrastructure may be transferred to other countries in the large emerging market sphere, especially those more active in commercial ties with China, and there are a lot of those in Africa and Latin America and elsewhere. And maybe as a second stage, China could contemplate the launching of a global digital renminbi, and of course, then the predominant position of the dollar would be threatened, and that's really what triggered, I think, one of the main reasons which triggered heightened interest from Western central banks in looking at the digital option. So very briefly, I think you have it on the slide. What are the main reasons why this lethargy of the Western central banks has been shaken off? Number one, the decreasing weight of physical cash in transactions, which we have witnessed for many years now. Then the obvious need in a digital ecosystem to have a digital version of the central bank money. Then in the initial stage, there was the threat of private stable coins, especially Libra. If you remember, Libra was that project created by Facebook, headquartered in Switzerland, to create a private stable coin. In other words, a private digital currency collateralized by real assets, safe assets, highly liquid assets. Now, due to regulatory barriers, this project was not pursued fast enough. And right now, Libra changed not only its name into Diem, but also the jurisdiction. They are moving back from Switzerland to the US. And not only that, but I think recently the chief economist of Diem said that basically they see themselves not as creating an alternative to central bank digital currencies, but rather as being able and willing, even happy to support the creation of a central bank digital currency with technology and infrastructure. So if that's the case, maybe this threat of a private stable coin is no longer as acute as it was maybe a few years ago. What is acute, as I said, I think, is the threat coming from China. So obviously, US and Europe say if China is going to go into a global renminbi or even to implement local equivalents of the yuan into various markets using Chinese infrastructure, then we have a problem. And not surprisingly, now everybody's pushing on these CBDC projects. Yet another reason is the growing importance of transfers, payments, and remittances from the private sector, from the governments, from central banks. Especially now during the pandemic, this has been quite a development. And clearly, by using CBDC accounts with the central bank, these remittances can be pursued much faster and safer than using various intermediaries, not all of them very efficient on the ball. Also, the not small issue of money laundering and improprieties can also be addressed. And last but not least, the issue of privacy. I think that if in the eyes of the general public and the markets, CBDC will be associated with, say, a Chinese version, which raises serious issues regarding privacy of transactions, then of course it's going to have a bad reputation. And that's why central banks of democratic countries are moving into looking very seriously at offering their own alternative. Now, coming back to the relationship between CBDC and banks, again, 2 points. One is that the central banks themselves have been quite explicit that they are not there to bypass or substitute themselves to the private banks, to the banking systems. Very specifically in its discussion paper published last year, the Bank of England mentioned as a main scenario that of a Bank of England managed platform in which so-called private sector payment interface providers, PIPs, which would be institutions regulated by the Bank of England, would have access and would go into handling CBDC. So I think that's a scenario, that's a template which is probably going to be adopted by other central banks as well. I don't see why not. At the same and equally, again, CBDCs only would substitute only one aspect, small aspect of what banks are doing, not the credit creation part, not the deposit taking part, the investments and other financial products which generate to banks fees and commissions. Of course, a big challenge will be for banks to embed CBDC in their offering to clients. Very often banks complain, especially those which depend heavily on mass retail, they complain about the 80-20 or 90-10 rule, the fact that 20% of clients generate 80% of revenues. Why? Because you have a large mass of non-performing or poorly performing current accounts which generate very little revenue to banks. Now, with the existence of transaction accounts in CBDC, maybe some of these extra balances could be moved out, which perhaps could improve the profitability for some of these banks. On the other hand, many of these banks will need to adjust their retail funding strategy, given that some of these retail deposit balances will move into CBDC. Again, CBDC being a direct liability of central banks, not of the commercial banks themselves. On the other hand, you cannot assume that all retail deposits or a large share of retail deposits will disappear. Why? Because you have, for example, for all the mortgages, you need to have large initial deposits, or for all the business loans, you need to have compensating balances. So all these masses of deposits will very much remain in the banking system. But I think there's more that central banks can do to limit the potential disruption, even if it's going to be more of a marginal disruption in the sense of having a maximum size to CBDC accounts, say 2.5 or 3,000 euros for an individual, and 5,000 to 6,000 euros for a business, just an idea, or to have only one account per end user, or obviously these CBDC accounts not to be interest bearing. Why? Because otherwise it would be an alternative for investments, when in fact I think CBDC should be viewed solely as a means of exchange, looking at the functions of money, not as a store of value, which is still the case, mostly the case with cryptocurrencies, private cryptocurrencies. So to conclude, in Europe, I think that the European banking system is well sheltered against against massive digital disruptions, with one condition, that the banks themselves are not digital laggards. So you have, in addition to the future CBDC, which will ease out, will crowd out private cryptocurrencies used as means of exchange. You have a future forthcoming regulation on crypto assets, the markets in crypto assets, MiCA. Then you have the Digital Operational Resilience Act, DORA, which is another piece of regulation being prepared by the European Commission for the new digital finance age. And of course, you have PSD2, which is already in effect. So the parting message for me would be that CBDC should not be viewed as a threat in and of itself for the banking system, but it will if it's part of the overall package of digital developments which would probably hurt badly, those banks which are not prepared for that. And again, 5G, tokenized assets, blockchain, and open finance and others. Which means that for those of us who look at banks, who assess banks, whether because we have to or we like to, it means that we need some new sets of tools to assess these banks' creditworthiness. So the old post-crisis, post-GFC analysis, asset quality provisions, do banks have enough capital? Are banks prepared for resolution? Do they have enough emerald, enough this and that? I don't think that's enough anymore. I don't think that's very clear in showing ourselves and the others that this bank is well prepared for the future. So these tools to look at the digital developments and the way each bank is prepared for them is becoming quite essential. And by the way, as my parting thought, banks talk, and we talk a lot about ESG and how banks need to adopt ESG strategies. And most of the talk right now is, and rightly so, focused on climate change. But I think it seems to be that the key element of ESG for banks should be financial inclusion and financial education of large categories of clients. And I don't see a lot of focus on financial inclusion when people talk about ESG and banks right now. I hope that will change. But that's my parting thought for that. So I'll stop here. Thank you.
Excellent. Thank you very much indeed, Sam, for those comments. There are a few questions that, if you're agreeable, I'll read out and perhaps see you have a stab at an answer. If that's all right. So the first one you kind of touched on. There's two aspects to this first question, and you touched on both of them. Perhaps you can recap. The first question is: do you see a risk that retail deposits become less stable with CBDC, and could this have an impact on ratings?
No, clearly, this if a bank's retail deposit base shrinks or moves out, that's going to have a massive impact on ratings. I would hope that rating agencies would, because as far as I know, stable funding is part of all rating agencies' methodologies, and rightly so. But I don't think that's going to happen. I think that is a threat mostly for smaller banks which have less diversified funding structures. And if that's the case, then I would expect this to be a problem. Again, it's not case A, it perhaps would be scenario B, but we have to, I think right at this stage, there's not a lot of daylight on how central banks plan to manage the issuance of CBDC and how, if they are going to do it through the commercial banks or not. So by the time it happens, say in a few years' time, my expectation is that the structure of the banking industry itself will be somewhat different, with fewer banks, with banks which will be more focused on specific business lines, and more consolidation among smaller banks. So we have to wait and see. And by the way, when I talk about smaller banks in Europe, I don't have in mind, say, German savings banks or Norwegian savings banks, because these banks are part of larger groups which have centralized function for digital technology, for investments in IT. I'm talking more about small banks without any support, peer support, or support of being part of larger groups.
Excellent. Thanks, Sam. You've been quite clear, in general, that be it private crypto or CBDCs won't pose an existential threat to banks, but you have said, you do acknowledge at the same time that banks need to invest more in advanced technologies and speed up their digitization efforts and infrastructure, which is a key point. I mean, is this happening in your estimation?
Well, it's happening with some banks. I'm not sure how it's got, because you don't have banks. You have a lot of banks which are saying we are ahead, we do this, we do that. I have yet to see banks which say we don't do enough. We wish we did more, but we don't have the money to do it. We don't have the specialized people to do it. Uh, and that's actually a concern, because as you stay behind, it's going to be incrementally more difficult to catch up, especially since technology doesn't stay at the same level. It evolves very fast. And if you don't keep up with technology, you find yourself out of the market and with a threat for your existence, basically. And the only alternative then is for you to throw in the towel and merge into another better prepared bank. This will be happening, I assume, but sometimes it's not going to be a very pretty picture to watch. Yeah.
Okay, very good. Yeah, thanks for that. So there are some potential issues out there. I've got another question here, Sam, which is as follows. One of the core drivers of cryptocurrencies is the paradigm that it would be a hedge against inflation, i.e. no QE possible. Are governments aiming to take all the benefits, DLT, efficiency, privacy, etc., but remain being able to manage digital money supply?
Well, I think I think that I think when you talk about cryptocurrencies and when you talk about DLT, usually people put them together because DLT came with Bitcoin. But at this stage, we should be talking about two different things. I'm more concerned about DLT, like banks not adopting, not moving into blockchain technology. And it's not so much because of the cryptocurrencies, Bitcoin or Ether being traded, bought and sold, but it's more about, the forthcoming surge. That's what people say, and that's why I observe around me, of smart contracts, which don't need to be used solely and are not used solely for cryptocurrencies, but can be used also for non-tokenized, for non-crypto transactions, which can be easily tokenized. And if that's not going to happen, and even I see some signs that some of the central banks say that they could see themselves putting CBDC on Ethereum, so which is a major blockchain network. So if that's the case, then if you don't have access to that, clearly as a bank, you're out of the loop.
Indeed. Sam, I guess there's a lot of discussion around the interplay between the private crypto narrative and the CBDC narrative. Question here, would you expect a CBDC to be fungible with private cryptos?
Well, private cryptos are basically, their value, they are not a unit of account. They are mostly a store of value. So the values goes up and down. I would say there's more connection, there's more similarity between CBDC and the private stable coins like Tether or in the US, or the planned Diem, if it comes into existence. To the extent that CBDC will take hold, I really don't see much value, to be honest, in private stablecoins. What's the future of private stablecoins? They are not going to replace central bank money, and they don't have the same investment attractiveness as cryptocurrencies like Bitcoin or Ether or others. So that's really what I think will happen in the future. But again, we keep making predictions, and then you have a new technology development which kind of blows up your predictions out of the water, and you're back to square one with something new.
Indeed, that's the nature of predictions, I guess. Sam, there's a question about bank capital reforms, which you just briefly touched on. And you mentioned post-2008 bank capital reforms, and the question is this: how exactly do those need to be changed to deal with digitalisation?
Well, I'm not sure that any reform of capital regulations are contemplated solely because of digitalization. I mean, digitalization. I think that banks, obviously, you need in Europe. You have the supervisory structure, and you have the four pillars. And you look at how the banks comply with the four pillars. And I think your digitalization would be part of your business model, of your risk management. But I don't think that if, could be wishful thinking. I'd like to see a supervisor saying, sorry, bank, you seem to be very much behind in your digitalization strategy and implementation. So we'll have a higher capital need for you than for your peer, which is better, which is more advanced, digitally speaking. I don't think we're there yet. We could get there yet, I doubt. So I think that capital regulation will continue to focus on traditional parameters, and maybe there's going to be some room in supervisory pillars. But I think it's too early. I wish we had more of a dialogue, for example, about CBDC from bank supervisors themselves. For example, I haven't seen anything concrete being published by the EBA on CBDC. I'm sure they're working on it, but there's nothing yet, or by national supervisors. I mean, central banks, of course, the ECB did publish a lot on the digital euro, but not the bank supervision branch of the ECB. So I think once the supervisors will express themselves more on these developments, then we'll know more about it.
Yeah, that makes sense. So the questions are flooding in here, so I'm going to keep on going. Here's another question. What would be the advantage for retail consumers to use CBDCs, given the new tools, P2P payments, digital wallets, that make money payment and money transfer much smoother? What's the advantage to retail customers of using CBDCs, given digital developments in payments?
Well, actually, I think it's a very good question, and I'm not sure I have a clear answer on that. The CBDC, again, I think is very useful in countries where financial inclusion is still something to be desired. But for example, if you go to Kenya, some 40% of the population have a bank account. Many more use fintechs like M-Pesa for payments. So if you have direct access up to a certain amount to central bank digital currency, that would help your finances. On the other hand, in Europe, I totally agree that there's not much of an urgent need for CBDC. If it's going to make your transaction faster and cheaper, then of course, I think you have an advantage to have an account with the central bank, either directly or probably via the commercial bank. But that's exactly what I'm saying. I don't think CBDC in and of its own, it's going to be a game changer for the European banking landscape. I totally agree with that. And when you have payments through private channels like fintechs, in addition to banks, I don't think these are going to be disrupted by CBDC. These would be different. For example, Klarna, which is a large fintech providing buy now, pay later services. Well, this is not something which is going to be provided by CBDC, clearly.
Yeah, indeed. But I guess the next question, really, actually from the same questioner, which potentially points to an advantage, is this: would you consider CBDC deposits more stable and safer than cash retail deposits?
Well, I'm not sure what's the difference between digital. What would be the difference between a digital euro and the cash euro? It's still the liability of the ECB. On the other hand, if your cash account is with a bank, a commercial bank, and you have a CBDC account with a central bank, which has ultimate responsibility for this account of yours, then yeah, I would feel safer with the CBDC account if I thought that my bank, my commercial bank, the bank where I keep my money, is not going to survive or is going to have troubles in the future. On the other hand, as we know from BRRD and from all the regulatory papers and structures, if a bank goes into resolution, I think retail deposits are fairly well protected up to a certain point.
Yeah, indeed. And Sam, you talked about new tools needed for bank analysis. Any ideas?
Well, I think new tools, first of all, before finding the tools, you have to have the expertise and the culture to look for these tools. So I don't think that by definition, the traditional generation of bank analysts, whether on the sell side, on the buy side, in rating agencies, have all the digital tools or digital experts, the technical experts to assimilate all these new developments and to come with their own tools. But I think it would be, to me, very interesting to, for example, be able to assess the stage at which a specific bank is in its digital advance. How far from the ideal point it is in terms of preparedness. How protected is it in terms of cyber risk? And the cyber risk is another actually huge issue, which I didn't talk too much about because it's so obvious. The more finance becomes digital, the more the cyber risk part of it is going up. And we see how hackers can disrupt, utilities and meat packaging and everything else, obviously financial institutions as well. So yeah, we're still looking for this sort of tools. And I think it would be a good idea to try to work together with the tech specialists in looking at a new way, perhaps a change way to assess banks and other financial institutions.
Yeah, makes sense. Sam, here's another one. The pandemic increased substantially the use of electronic payments and decreased substantially the use of physical cash. This trend continues. So why should the ECB invest in the creation of CBDCs and not enhance the use of existing electronic transactions infrastructure?
Well, I mean, the two, I don't see any possible opposition between these two. First of all, yeah, the ECB is very much focused on enhancing the safety and speed of electronic payments, and rightly so. Not only the ECB, but also the European Commission with its regulations, with its PSD, the Revised Payment Services Directive, PSD2, which is now in effect, and other pieces of regulation. But at the same time, the basic commodity for all these transactions remains the euro or the pound in the UK or the dollar in the US. So it makes a lot of sense to invest, at least to me, to invest in a digital version of this basic commodity than to keep it in a physical form, even if the private payment means keep evolving. At some point, the gap between the physical cash, which is increasingly left aside, and the electronic payments is widening, and that's why if you have a digital cash, it's going to keep pace with these developments. I wonder when was the last time, how many times during the last week people have used physical cash. I try to remember myself maybe 1 month ago. So increasingly cash is not being utilized unless you have to get some cash from an ATM to buy something from the supermarket if you don't want to use your card. So that's a new world, and if the central bank currency doesn't keep pace with this new world, especially when you see China doing it and others, then I don't think it makes a lot of sense, to be honest.
No, indeed. Sam, you mentioned Handelsbanken working with the Swedish central bank. And there's
Yeah.
a question here about how closely are banks working with central banks on the design of possible CBDCs. Can the banks shape designs to prevent disintermediation?
Yeah, I hope so. I'm not sure that at this stage, actually, banks work with central banks in Europe, other than in this case of Riksbank with Handelsbanken, because, and I'm really not sure what happens in some smaller, like I'm sure in the Baltics, people are very focused on that. But I think in the UK, in the euro area, I don't think the banks yet have been called by the central banks to get involved in a proactive way into devising these CBDCs. Why? Because the decision, for example, by the ECB, the decision to go ahead with the digital euro has been not taken yet. That's the same, very much the case in the US. But I'm sure the banks are lobbying, the banks are talking to central banks. The banks have their own ideas, and rightly so. They have research teams inside to look at this, and some of them, of course, fear disintermediation. Personally, I don't see disintermediation as being a big troublemaker brought by CBDC. But again, we are in the business of making predictions which don't hold at some point in the future. So what can I say?
Indeed. Okay, Sam, how about this one? The FSB on Monday said it wants cross-border payments to be possible within 1 hour at just 1% cost by 2027. Is CBDC a necessary condition for this?
No, probably not. I mean, cross-border payments, you have now cross-border payments. It takes some time, but, it's not like if you don't have because again, CBDC is the primary commodity for it. The means of payment can evolve and do evolve, and, have electronic payments. And of course, what the FSB wants is, laudable. But this is more a way of forcing the banks not to sit on the money, and to live off the float, it's still happening in the US, at least until the FedNow system comes into place. So yeah, but I don't think that you absolutely need CBDC for that. But once you have CBDC, that would be made much easier, I would assume.
Okay, indeed, thank you. And Sander, you talked a lot about China in the context of China, the risk of government control and lack of privacy. And there's a question related to this, not to China, but more generally, which is if a CBDC account is in a central bank, is this nationalization of a private side role?
Well, no, because again, people are not going to put their life savings into a CBDC account. I assume the CBDC accounts will have a limit. You cannot put, hundreds of thousands of euros in your CBDC account. So these are only transaction accounts for what you need for daily transactions or for weekly transactions. So I don't see how this is going to disrupt. And on the other hand, until proven contrary, I think the central banks in the UK, in Europe, in the US are independent or quasi-independent. I'm not sure how, and you have privacy rules, and so I really don't. I think pushing, believing that it's a creeping nationalization through CBDC is a step too far. On the other hand, if the process of transferring funds from government or from central banks into people's pockets is made easier by CBDC, then why not? On the other hand, as I understand, the big source of fees and revenues during the pandemic for banks has been the distribution of government-granted loans. If these loans go straight from the central bank into the end users' pockets, then of course banks, commercial banks, will lose a source of intermediation. But that's a fact of life, that in general technology evolves in the sense of helping the end users and not the intermediaries.
Yeah. Indeed. Sam, we've exhausted our questions, so
Okay.
thank you so much for answering those actually blind. And so I think unless there are any other questions, or unless you want to say anything else, Sam, I'm happy to bring the session to a close. And so thank you for your incredible comments and your knowledge on this. Thank you to those of you who dialed in and stayed till the end. I hope you found that useful. Now, as I mentioned at the beginning, it would be a great favor to us if you could spend 45 seconds on clicking on the feedback form. Literally, it's just a click here and just fill a few details in. And before you disappear, it'll be a great help to help us perhaps shape future events. So thank you for that. So we'll leave it there. This topic of central bank digital currencies and cryptocurrencies, the interplay between them, and amid the ongoing digitalization of the financial sector is clearly going to evolve, and I suspect quite quickly. So Sam, here's one prediction I can make, which is that we will revisit this subject at some point in the not too distant future. So thanks again, and we wish you a very good rest of the day, and we'll see you next time. Goodbye.